Good morning, everyone. My name is Khyati and I am by profession a startup lawyer. I'm thrilled to be the moderator here today for this session called Navigating the Funding Landscape. What do investors look for? We have a stellar panel of experts here ready to share their insights on what makes this startup funding landscape so dynamic and interesting. In the next 1 hour, my goal is to dive into recent trends, explore the minds of these investors, and uncover what makes a startup fundable. Whether you are a founder, whether you are just starting, or you're just somebody who's eager to learn about how funding happens in the startup ecosystem, this session is tailored for you. I encourage active participation. We have a short Q&A round right at the fag end of the session. So don't hesitate to engage with our panelists. Without further ado, let's dive in. I think we have a cut-off time limit, so I better cover a major part of this session with a lot more interesting questions that I have. Basically, my goal of starting today was to first, we are meeting in the first month of 2024. Goal was to understand certain current trends that are helping investors actually make investment decisions, to understand how startups actually can align themselves with those strategies and become fundable. So I'd start with Divya. What are your thoughts on the current funding landscape in India?
Great question, Khyati. And I'll try to be brief because there's so much to talk about. I think we're coming off a year of certainly globally, it has been a year of the lowest amount of venture funding. India is not an exception. I think funding is at an all-time low, both globally and in India. I think last year has been probably the lowest funding in 10 years, in a decade. So it's certainly been a year of slowdown in VC funding, early stage funding generally, angel funding, VC funding across right through to the IPO stage. So a number of factors have led to this situation. One is certainly we're coming off a cycle of extremely high valuations and hype in 2021 and the early part of 2022. We suddenly realized that there were some very high-profile startup scandals which we discovered in terms of governance, in terms of use of funding, and so on. So that's all had an effect on the funding climate and the investment climate in India for early stage. There have also been other contributing factors. There have been a couple of worldwide wars which started. From an LP perspective, the Fed had increased rates. So yields for large LPs and institutional LPs, the RBI had also increased rates. So the temptation for HNIs and LPs to put money into safe avenues had sort of dried up some of the available funding for even VC funds or angel funds trying to raise money, right? We're coming off that. So I suspect now the good news is for startups, VC funds and angel funds and alternative funds are sitting on a lot of dry powder. So I've heard between 18 to $25 billion of investable money, between 18 to $25 billion of investable money waiting to be deployed in the first couple of quarters. And I personally believe that the India startup market is capable of taking up to $25 billion per quarter. There's that many startups waiting to be funded. So I would expect deal activity to start picking up. So if you're a founder, this is a good time for you to get your house in order and start doing some intelligent search for funding, investing organizations, VC funds, angel funds that are aligned to your business to start looking for sources of funding. So I would certainly expect 24, calendar year 24 and more importantly fiscal year 24 for India to be the start of the turnaround from a funding perspective. I'll stop there because I'd love to hear other folks' thoughts on this as well.
Do you agree, Pranay?
Yeah, I think as Divya mentioned that now being we have seen the funding winter in the last year, and VCs, angel investors are looking for I think the right kind of match now. There is no FOMO investing happening, and uh, this being said, that now founders, because I see a lot of startup folks here, or maybe aspiration, they want to start their startup. I think they should know that whom they should reach out, and it is very important that you reach out to the right kind of investor. You should, I always say uh, that every money is not the right money. You have to find the right investor. You have to start rejecting investors. If you don't bring the right investors, you don't reach out to the right investors, you will have a long way to raise the funds. You will have difficulty in raising funds, and you will be, at the end of the day, disappoint yourself in raising funds. So I think founders has to really understand how funding works, how investor thinks, what are they interested in, why they reject a startup. I think that research is very important. That is the outside view that you should have. uh, it's now very easy because investors are also putting out their thesis. So if there is a investor base who are looking to invest into D2C, so if you are building a D2C startup, you should try to reach out to D2C investors, who investing into D2C uh, startups, or something similar in which they have already invested, and you could be a good match for that startup as well. So I think those kind of theses that you should be aware of. And I think it is more important that from an inside perspective also, you build a startup, because there's a lot of competition. A lot of startup reaching out, like we get about 150 applications every month, you know, uh, directly through our website, apart from somebody reaching out to on LinkedIn and coming through some core investors and things like that. But there's a lot of competition also for the founders. So think about, like, how can you make your startup stronger inside out, uh, like, whether it's about product, whether it's about team, whether it's about how you're managing your finance, legal stuff. Um, I think that things are becoming more critical, and founders have to really understand it. It's not like, oh, I have a great tech product, now I should, because my friend has raised the fund, I should start reaching out to 100 investors and raise the funds. You should really be prepared. uh, Otherwise you will have a lot of issues and concerns in raising funds. That's my 2 cents on this question.
Thank you. Thank you very much. I think, just to drop in a few numbers, I was just like looking at the amounts that were invested in the past 2 years and what we closed as of December 2023. And what I found out was that India was the fourth most funded geography globally in 2021 and 2022, and we fell by a position in December 2023 with about 38 billion invested in 2021. We dropped to barely 12 billion in 2023. Now, being a founder as it is, is very challenging. I understand, I get that, right? To add to that, a funding squeeze does not make it any easier. Having worked with, now over 100 startups, I could say this, looking at these statistics. And excuse me for dropping a Game of Thrones reference here, but our own little finger said that, you remember in one of the episodes when he says that what we don't know usually is what gets us killed, right? And the reason why I make that reference is that, even during the chaos, businesses that thrived, that did well, did not act ignorantly. They were in fact well prepared. You see companies like Insurance Dekho, Mintify, Zepto, Fresh to Home, all of these raised more than 100 million plus. Uh, amidst intense winter funding. So it is fair to say that money eventually does find good businesses and good founders. And which brings me to my next question, Vijay. What are some of the key factors that you see or that catch your attention when you are evaluating potential startup investments? How do you identify promising startups?
This works, right? Yeah, thanks, Khyati. So, hi everyone. First of all, good morning and thanks a lot for collecting here. Right. As I guess Divya already spoke a lot about the whole ecosystem, and then Pranay was quite apt about talking about how the startup ecosystem evolving. Now, talking about how we evaluate a startup when it comes to us, right? I will just take a reference from Khyati, your numbers, which you just said, right? And it reminds me because today the evaluation process has gone high because the levels and bars are too high. I remember 2021 was a time when there was a saying, and investors used to say in the shrewd way, कि गधे घोड़े सब बराबर है. Money is flowing, just grab it. And people are investing left, right, and center. I remember categorically when every week we used to, we have a weekly deal roundup when we issue in a week how many funding has been floated into startups. And I remember for a streak of 10 weeks, I was getting that in my inbox and it was $1 billion floating every month. And I was the guy who was telling startups ki currently it is COVID going on, you just slow down, you just reiterate, change your business, but money was flowing in, right? So we have seen that times, and now the times has come that the funding winter has already, I guess, little down, as you said, right? Dry powder is there, they have to evaluate good startups. Now coming back to the question, I just got carried away with the discussion. Right? But yeah, coming back, see, I guess many of you are startup here, right? Can we have a small raise of hands? How many of you are really founders of any startup? 1, 2, 3. Okay, great. So see, whenever startup comes to us, there are few things which we, or I would say from behalf of many other angel funds or angel networks, what they do look into, right? The first thing is who is building the company. So we would love to know about you as a person. What is your background? If you're building a tech, do you have a tech background itself or not? Or you're just coming out from a job because you think you can do it, but you don't have an experience of doing that. Second thing which we look into a startup is the kind of track record they have built up in past. So idea stage funding is long gone. I don't think so. You should be getting motivated of seeing that idea stage companies can get funding. Not from serious investors, definitely your relatives and other people can bet on you, but they're looking for track record. So track record is second thing which we definitely look into, what you have done so far, your revenues, your numbers, we look into that. So as I said, the founder and then the team which is building it. So if you have already built up a team which is committed even to work with you, and in the background they are functioning in the process you have built up. And foremost, the problem for which the solution you are building up. So we keep our hands away from startups who have created imaginary problems to provide a solution from their products. Like that's quite funny. We find out these startups day in, day out. And now Shark Tank is there for you go to and see the pitches. We don't have to keep that closed door. It's out there. You find companies which are creating problems unnecessarily and then creating solutions for it. So we look for those things. And last thing, I guess, the scalability. So long gone, I guess, we have kept our hands away from companies who are in services. Services is not that scalable what we think as a thing. It should be productized. Maybe it's a service today, but maybe it can be productized in future. So we look for scalability as an aspect, right? And to just summarize this, I guess something which is investable is when you put all these things into a basket, you will find out that company is investable because the team is stronger. The company has a track record. The solution they are providing is for a real problem, and the founder has an experience or is committed to build that. Right? We have even invested in a company where the founder was 23 years old. So people questioned us, why are you investing into such a young age guy? But that sharpness and the person has all that. What he is doing from last 10 years, like he was 13 and he was investing into private market, so we invested in that company. We, like Shubham is sitting here, he invested, we invested. So that's how we look into the startup, how the, all these metrics coming in, and I'm sure many people would have different things to add to it.
Do you mind if I add one quick comment? See, I'll tell founders one thing which hasn't changed, right? As investors, we look at the value that you're providing to customers. Why are customers willing to pay for your product or service over other people's products or services? Fundamentally, this has not changed. Funding winter, no funding winter, this is a true differentiator. There are a few other things, I mean, we're now sort of emphasizing a lot more on governance and execution capability, as Vijay was saying. But this one thing hasn't changed, will not change.
Thank you. I think to sum it up, what I've seen is having represented a lot of institutional investors myself, investor writes a check only when they hear an idea which is compelling. When they see a team that can realize the vision that you actually so, in a flowery language, basically pitch when you are pitching to the investors. And when they see a real opportunity, just to add to what Vijay's point was, that don't create imaginary solutions for imaginary problems. But I would say this, that some founders organically accomplish that. They get to that part, but others don't. Others need to be coached, others need to be prepped. And on that note, my next question is to Vittal. I read about what Pod does, and we'd been even talking even before the session. So for the audience, Pod is a full stack fundraising platform that even enables retail investors the opportunity to invest in startups. Your FAQs on the website said that you have a full-fledged team that basically does the market research and vets the startups and then connects them to the investors who have signed up with your platform. My question to you is that in your experience, what are some of the challenges that you and your team have seen founders face when they are going ahead and raising funds? And what's your feedback to them when you are actually vetting them and considering them to connect with your investors?
Hi, good morning all. I think I'll just take extension of the question which you previously asked, right? The vetting process. I always say we should follow a 4P principle. 4 Ps. If you're having a painful problem to solve, and if you don't have paying people, right, the idea is not going to take off at all. So that is essentially what we vet in everybody. It does not matter from what industry you are in. At the end of the day, if a customer is paying you, there are investors to fund you. Very simple, right? Because investors are here to look to increase their returns in the money they have invested in. And they don't specifically have particular sectors, especially the individual angel investors where we operate in. Having said that, we do face a lot of challenges from the founders because the founders are not actually aware of how fundraising happens. They believe that there is somebody waiting to write a check right away, which is usually not the case. Then they start preparing for fundraising, understand what the process goes through, which we tell them beforehand. So this helps them reduce their preparation time for fundraising and actually go to raise on funds. Which is why, even if you visit our website or when I'm pitching to somebody of what Pod does, we say, anywhere else you go to raise funds, it takes 3 to 6 months. With us, it takes 3 to 4 weeks. That is the average time we close every single deal, end to end with documentation. So preparation for a founder is very important, whether they're raising funds or not, something which I always advise upon. Keep your data room always ready, end of every month, mandatorily. Whether somebody asks or not, it is for your own diligence, not for external due diligence. Once you are diligent yourself, then externally it is just going to be very smooth. And I'm sure you come from a law firm, you would have understood the problems of due diligence, right? You have to do at least 100 emails to and fro with the founder, asking for multiple documents. I think preparation by a founder is something which is underrated, something which many people don't talk about. Multiple networks are there to reach out for funding. But as a mindset of an entrepreneur, always be 2 steps ahead of the market than what it needs. Then the investments will automatically flow in. Thanks.
Thank you. I think I relate to that a lot. When we talk about data rooms, the first thing I get is that, ma'am, there should be something to post also in the data room, no? We don't have any documents, right? Now this investor is showing interest. You help us curate these documents that are up to date. So anyway, I think moving on, I want to touch briefly also on, since we are talking about funding, also on the sources of funds. Because, you know, although VCs are the most popular source of funds these days, they are not the only ones. And very few founders know that. Depending upon the stage and needs of your business, you may or may not require equity financing. You can even consider debt financing. And which is why, help me out, Saurabh, a bit here. StrideOne is a tech-led financial services platform, and your focus seems to be much on need-based credit and non-credit, you know, funding these credit and non-credit gaps for startups. Could you tell the audience something about why should startups actually consider debt funding? What value does it bring?
Yeah, thanks, Khyati. So, startup ecosystem has evolved over the years in India a lot, and so is the financing ecosystem. You know, while a lot of focus has been on how to source equity for the startups, I think, once the startup has raised a certain amount of capital from either angel or VC funds and has achieved a certain MRR, I think they should also scout for bank debt or NBFC debt. So, over the years, a lot of NBFCs, AIFs, even the banks have started the new age corporate verticals wherein they are funding startups both on the short term and the long term requirements. So the value that debt brings to the table is, it elongates your runway. So in a way, it gives you a higher valuation when you're going for a next fundraise. Venture debt gives you a long-term 18 months to 36 months kind of financing, which you can use it for the growth capex that you're planning to do, or maybe brand building or any kind of product development. Recently, couple of NBFCs have started doing working capital funding also. So working capital is actually an underrated product because, most of the founders would be knowing about venture debt, but working capital is more of a permanent nature. They are, if you're availing working capital financing to finance your procurement of raw materials, or maybe the Facebook payments or Google payments, or financing your inventory or on the receivable side. So this is, as your turnover grows, as your volume increases, you will be able to attain a larger share of bank finance, which will support you in the growth journey. So in a nutshell, bank financing has to be coupled with equity investments, and this will only increase your ROEs and the valuations.
Great. I think a follow-up question to that I had was that, is there any kind of right mix for a debt and equity ratio that a startup should consider?
So, so in the SMEs and mid corporates of the world, there used to be financial ratios, which I'm sure, people would have read about it, 1:1, 2:1, debt equity and all. But I think in the startup space, you should be slightly more prudent. It entirely depends on, what kind of investors' confidence that you have. And we should be slightly prudent enough to have ample liquidity so that, in case of any event risk, be it the economic downturn or any investor sentiments that is happening right now, we should be prepared for it. So basically, debt has to be coupled with equity, but not over leveraged.
Understood. Thank you. Thank you for that insight into debt funding. I now want to transition a bit into the investor decision-making process. I think most of you here know that investors are in the business of making money from money, right? It's literally their job. So every founder who's not been able to scale or contribute to growth or been able to achieve a higher valuation, chances are that the investors will not invest in your subsequent rounds of funding. That said, I mean, I recall a very, very recent conversation that I had with a startup founder where he made a very, very interesting comment. He said that, investors want to make a profit, but they seem to quickly reject most of the startups that approach them. How do they understand that whether this will work or not work if they don't listen? Any thoughts, guys?
Yeah, I think being a early stage investor, as you mentioned that a lot of startups at early stage don't have a data, right? So we cannot even ask them to send their P&L balance sheet so that we can look, okay, what is the revenue looks like, how is the PMF, because in some cases even product market fit is also not being achieved. We don't know really if customer really like this product or not, right? Uh, so the only thing that we rely on is the founder, the characteristic of the founder, the personality of the founder, the mission, the vision, the purpose the founder is holding with him or her. And that's what we really bet on, right? Uh, so so we literally actually date founders. We just, okay, coming on a half an hour or a 1 hour pitch call and decide, okay, we want to really invest in this company. Unlike Saurabh can really ask them to send the data, we actually land up in their office, meet the team, look at the product, spend hours and hours to really understand the founder and the team and the vision, the product roadmap, the business plan. So we sort of become kind of a co-founder. We are not co-founder in the company, but we actually start brainstorming ideas on product, on team. Somebody is a solo founder. They don't have a co-founder. So we try to find people who can be co-founder in the company. We give them the ideas that who can be your co-founder in the company. So literally we are at that stage. And so this is how a life of a VC looks like, right? For a startup, it's important that they, as I mentioned, that it's a dating between two people, before they marry. And that means they decide to invest in that startup. So founders should also know that what kind of investor is right or wrong for them. They should gel with them. They should understand, founder's priority, what is founder's vision. So if you're a founder, you should always seek for those investor who shows interest in your idea, right, or the product, and they are able to add value to your product, either by connecting you with a couple of business connects, because like what we do, we have about 600 investors in our network. So we first, as soon as we receive a pitch deck, we try to think that, okay, can we help this founder bring business in the company? So we try to give references this founder and connect with their potential customers. So that's what we do, right? And that's what founders like about us. They come to us for that sort of thing. So before we actually start investing, we start contributing to the company. That's our sort of way of working.
Divya, how does it work for you?
Like Pranay said, it's important to find investors that are aligned with your business and who have some sort of. So I'll take a step back. See, first of all, founders and investors, particularly institutional investors, whether it's an angel fund or a VC fund, remember that first and foremost, you're looking to build a longer-term relationship, right? Once those people have a piece of your company, it's like almost like being in a marriage. Assume that you are in a long-term relationship with this entity. So when you go in, it's a two-way street, right? So the question that you ask, Khyati, is, which is the founder saying, how can people make such a quick decision without even listening? I'll share a few statistics, right? Our funds, on an average every year looks at 1,000 startup propositions, right? We screen 1,000. We fund up to 4 to 5 per year. So you do the math, right? And even if of those 1,000, the ones that actually make it through the screening process are aligned to our thesis. We have certain priority sectors. You can find them on our website. You have to be, climate or sustainability, food or agri-tech, health tech. If you're not aligned to those areas and you come to me and you're saying, you're from some completely different sector, you're a, you're a consumer product startup which is not aligned to any of my thesis areas, then our screening team is going to say no very quickly without even listening to you, right? So it's definitely a two-way relationship where you do a little bit of research, figure out whether this fund's thesis or areas that they invest in is aligned to what my business is. Secondly, there's a lot of competition out there, right? There are lots of startups and the vast majority of them, this is the harsh reality, do not get VC funded. The vast majority of startups, this is not unique to India, worldwide, the vast majority of MSMEs do not get VC funded, right? A very small proportion of them get VC funded. Now, there's a whole step process, some things that we look at don't change when we're looking through the due diligence process. I don't want to eat up this time because I also want to make sure that we hear Vijay's perspective. Alignment to our thesis, stage of the company, because most funds have a thesis on what stage they will invest in, right? We, for example, are a post-revenue company. We invest in early stage, but you have to be post-revenue. So if you're seed stage, or if you haven't found product market fit, we're not the right fund for you. Don't waste your time. We'd like to hear from you if you're an interesting line of business. What are we looking for? We're looking for customer value. Are people willing to pay you money for your product or service? We're looking for innovation and the ability to scale. And we're looking for governance and execution. We've always been very clear that if you don't have a very clear, sustainable path to execute and be successful, build a solid, sustainable business, we are not the right fund for you, right? We tend to be pretty focused on how well can this team govern, execute, be transparent, grow, etc. I'll stop there, but fundamentally, the thing to remember is it's a long-term relationship. You're giving away a part of your company. Remember, these people, whoever funds you is going to have a piece of your business. They are going to have a say in the way that you run your business in future. So it needs to be due diligence on both sides. You have to be comfortable with that relationship. Assume that you're going to be in a relationship with them for 3 to 10 years or even more, right? That's the starting point. I'd like to hear from Vijay on this topic as well.
So I guess Divya's answer summarizes this whole problem, right? Let me tell you some backstory about it, right? Startups have always a complaint, as you started the question, that VCs don't listen to it, how they will judge that you want to invest in them or not, right? That's not a problem. There's a different side of it. Let's step into shoes of the VC. I have been working with the VC funds from last 6-7 years. The problem is they have, let's say, 100 crores to be deployed in a year, but they have to deploy into 5, 6 startups, right? And applications they receive is enormous. You can't put them in numbers. The categorized data, what they receive on emails versus they receive on their online application portals, it's typically a mess. You can't actually pick up right set of companies at right set of time. And as we are discussing about the data rooms, the data is not ready over there and all. Talking about Soonicorn Ventures, we have invested into 40 startups so far. All these come, and we have to invest every month 2 or 3 startups. That's our mandate. We want to be that fast, right? And we receive close to 200, 300 applications across. Like if they are into some angel fund, they will come directly to us, and we have networks out there into the market, right? So what happens is all the funds have a different thesis to follow. They have different mandate under which they have to multiply the monies of the LPs also they have received money from, right? So when the startup thinks that guy have written agnostic, that have invested in my similar kind of a company, why can't I go and that person should invest in me? That doesn't work that way. So the best approach, what we have, guided our portfolio startups, or maybe what we have been doing so far. You have to first understand the kind of VCs in India who are actually investing into the similar category or the sector, right? Everyone has a biases towards a sector. So you have to find out those sectors, the ticket sizes they do, the stages in which the company do. And irony, or I would say, is that this data is not very freely available. Good VCs, like as Divya said, they will put on their website, but majority of them, you have to first check with their analyst, whom you're speaking to a fund, you have to first get their thesis. If that is fitting to your company, you should poach them. Otherwise, you're just wasting your time and their time also, right? So this data is scattered. In some sort, you will find some data rooms where you will find like Traction is a good platform. You can go and find data of VCs who are investing in similar sector, ticket size, industry, they have a past track record. So ये बहुत सारा crunching है. How you are looking out for VCs, even VCs are looking out for good startups. And I can tell you the like I have been into both sides. One side where we were approaching VC funds for the startups on sell side mandates. Today we are investing into startups, and both sides have the similar problems. The right handshake has to do. For that, a lot of homework has to be done from the investor side and from the startup side. You have to categorize the right set of investors, then reach out to them, and it's a slow approach. It's not that you're going to get funded in, let's say, very quickly just because you think you're ready. Right? The VC has to do their due diligence. The time has to be taken. There are platforms which can give fast funding, as Vittal rightly said, 4 weeks, similar timeline we follow because we have pitch calls as I said, we have to invest in 2-3 startups every month, right? So there are fast-paced VCs also. You can approach them, but you should know whom you're talking to. Are you wasting their time or yours, right? That's my sense on it.
Thank you. I think that the summary of that is that, A, research, and B, start early. Because in terms of raising funds, you don't know when the funds would actually hit your account. So you better start talking and researching early, just so that you know that by the time the funds come in, you're not just like all dried up. Adding a flavor to this, I just wanted to know that, from an investor point of view, a lot of founders have this question in their heads that, what is it that they should not do to end up in your reject pile? What should they not do to actually be not considered? Is there something, are there any interesting stories? Are there some, there are always classics, but I would even be eager to hear about stories where you saw a very, very viable, startup investment potential, but you didn't because of something that just didn't click.
I'll start, but I'm sure all of us have stories. The first and most important thing that I want to emphasize to founders is please don't lie. If you lie and you get caught, even if it's something that you feel is innocuous, you feel like you're trying to present something in a way that the investor wants to hear. As soon as we figure out that you're being inconsistent, this immediately closes down the relationship. It shuts down any possibility of you having a relationship with this VC because you've kind of failed the first test. And what I mean by this is, I won't get too specific, but when you hear a pitch from a founder and you give them some feedback saying, here, this is very interesting, here, and the next week when they make the pitch to the broader team, they've actually changed their pitch. It's not wrong to pivot and improve your story, but you change your pitch fundamentally so that what you presented last week becomes completely the opposite of what you're presenting this week. That's not going to get you funding, guys. So fundamentally, be honest, be transparent, be open, take feedback, incorporate that feedback, but don't lie, ever.
I have a different view. I mean, we are okay. Let founders lie. They are actually not lying. They are actually creating a story, crafting a story which does not exist. We have to understand that, right, as a VC. So we are okay for the founders creating stories which does not exist, because that's create billion-dollar stories, unicorns. None of the unicorn had an idea that they were all stories being sold to VCs. And VCs bought their stories, and other VCs after that, every VC bought their story and become a big story, That's how it really happens, right? So that's not a lie, that's a story. I think what, for us, being at real time, the people, the founders who does not really know their own value, So if the founder comes with crazy valuation, that is something which puts us off. They really don't understand our value. So again, boiling down to that, when you are approaching somebody, understand who you are reaching out to, and have the right story to pitch. You don't have to have the same pitch for every investor. You can also customize, personalize the pitch, the deck, the data, what that investor might be interested in. The same thing doesn't work. We talk about data rooms. the data room doesn't work same for everyone, you know. So you might have to have a 2-3 different versions of the data room for different kind of set of investors, you know, or probably keep those things on top. You can have 50 things, but if you are pitching real time, then you should know, okay, what real time might be interested in, and put those 5 things on top, right? Instead of just telling, okay, randomly, okay, Pranay, check these 50 things. I don't have time to check 50 things. You know, you should know me, okay, what exactly I'm looking for. So I think if founders is interested in working and showing interest, they understand our priority, and as soon as we find out that they are not aligning what we think and what is important for us to save our time, I think that deal doesn't happen. Every founder is great for us. The product they are building, the dreams they have, I think everything is good, but I think the matchmaking is very important, and that if we don't see that the founders are not taking enough interest, you know, the kind of things that we want, that is something a deal breaker for us.
Yeah,
Vittal, yes.
I would like to add. I think I definitely agree with almost everybody from all perspectives. But what is important for a founder is this is more like a tug of war, right? Two ends of the spectrum. One is optimism, one is realism. So it is very important for the founder to be realistic and also be optimistic in terms of how he's projecting, or as Pranay mentioned, in telling your story. But too much of realism, one side of the war is over. Too much of optimism, the other side is over. So you need to find that balance and ensure that the game is running on forever. That is how you are going to win. So having said that, I have two instances, what we have seen in our portfolio as well. One is an ice cream startup, D2C brand. We thought we are taking a huge risk in allowing them to get funded on the platform. You know, it got subscribed in just a matter of few hours. We were shocked. We thought, wow, this is incredible. Then came another deal, which was backed by a superstar in India, you know, in EdTech. We thought, wow, we have cracked an amazing deal, and this should also get funded in few hours, if not few days. Absolutely nothing came into that fund, right? So I think that puts us a perspective of how investors look at the deal, whether they understand what the founder is truly doing, what he wants to do, because we also see a challenge where founders don't tell what they're actually doing, you know. So we always vet the startups in a way telling, do you understand what are you trying to build first of all? If that is clear to you, then you will be able to sell it to somebody else. That for me is very important. Thanks.
Absolutely. I think I work with a lot of SaaS founders, and they are terrible at saying and narrating a story about what they are planning and trying to achieve. So sometimes you have to work with them to try and, you know, get the layman understand that what they are trying to do and what they are trying to build. Anyway, another aspect that I wanted the audience to know about is when to raise. Early on in the discussion, I mentioned two of these companies, Zepto and Insurance Dekho, that were successful in raising more than 100 million of funding rounds when there was not a funding winter. But quite typically, one fact that stood out, and when I was researching these companies and their fundraising process, was that Zepto was very quick in terms of raising funds. And Insurance Dekho took some about, you know, close to 4 years roughly to actually raise funds. So my question is that should founders take time to get their business in order, or should they just go out and raise funds because they think so? Saurabh, we can start with you.
Yeah, I think investors, right time is definitely important, and right investors, as you know, the panelists have been saying. So I think what we have seen over the period is that there are themes driving the investments. You know, sometimes earlier it used to be groceries, then it used to be agri-tech, health tech, and all that. So you know, you should have a differentiated product, and you should not miss the bus. You know, once that FOMO is happening on the investment side, everyone wants to invest in a particular space. I think if you are there, you should try to raise funds as early as possible, and try to be slightly prudent. You should raise maybe a larger check so that it funds your requirements over the next couple of months, rather than raising small investments and planning a bigger raise for a larger valuation. So I think it's while it is important to have a overall larger share of pie in terms of shareholding, but also important that as a going concern, the company continues to perform, and wherever the pie gets bigger, even if you have a smaller share, at least there is sustainability in that.
Vittal, do you want to add to whatever Saurabh said?
Yeah, for sure. I think most of the people agree that, we just told investment is more like a marriage with the founders, right? So when do you start the proposal for the founder? It begins way before the marriage. It's just like dating, apparently. You need to touch base with investors right now, even if you are not raising. The best time to raise is when you don't want to raise. So touch base with investors, say hi. Day one, say hi, I am building this, I am so and so person. Have a face for the product what you are trying to build. Say I am starting at 0. Touch back again after 2 months, say this is my revenue number 1. I am the same person. So if you are constantly keeping in touch, this is where people understand you are building something. And that is where investors get interest to invest. So this is how I would like to summarize. Thanks.
Great. I think helps you get market insights. If at all, you are busy talking with investors, even if you're not raising. One thing that basically I just wanted to, highlight and mention, because, being a woman, I couldn't help but notice that there is only one woman investor sitting in this panel. And wouldn't it be even cooler to have more women rock the investment scene? Hell yes, right? But Divya, I just wanted to ask that for women founders navigating the funding landscape, what's your advice in terms of increasing visibility and access to capital?
Great question, Khyati. I'll say, there are two things. One is a woman founder is a founder like every other founder, right? So the problems in many senses are the same issues. But as a woman founder, what I keep saying, and I mentor women founders and I speak to women founders and co-founders all the time. Just given the nature of the business, quite apart from the fact that, you may have a very successful winning proposition which is looking very fundable, or you may not. I mean, you may need some to work on it, you may need to build it up. But what we have seen is it takes longer for women founders and co-founders to raise money. So be prepared for that process. It's the harsh reality. I want to take a step back though and say that, whether you're a woman founder or a founder, this question which you started off, and, we've been hearing really interesting perspectives and I agree with most of them. The fundamental reason is, when should a founder start raising money? Everything is driven by your business needs, right? Depending on Zepto and insurance, they are two very different kinds of businesses, right? And obviously, as you said, they had very different approaches to fundraising in the terms of the stage and how much they raised and when and so on and so forth. Like Saurabh has been saying all along, your business, you understand as a founder, you understand your business requirements and what those funding needs are for the business better than anyone. Don't neglect the various kinds of funding that are available to you. Definitely look at things like government grants. A lot of states actually have funds to give you for free. Take that money, take friends and family money. Avoid diluting too much very early. Don't take big institutional checks and give away 50% of your business early, because you're killing your ability to execute as a founder. Look at debt, look at working capital financing, which StrideOne provides. Look at NBFCs, look at bank loans. Look at all the different types of funding that you need and then work appropriately. Be prepared for, like Khyati said, be prepared for the money reaching your bank account to take longer than you think it will. If you start fundraising from a VC fund or whatever it is, some like Pod said, like Pod does, make sure that the funding process is done in 4 weeks, but it's more typical for it to take 6 to 9 months. Be prepared for that, right? And again, because I want to make sure that we also make sure Vijay has a say on this, I'll stop there. But
see, I guess we are anyway out of the time, but all the perspectives are absolutely correct. When to raise, and I will say why to raise, right? Do you have to evaluate, you should raise it or not? although coming from investor, this is very, how would you say, detrimental to what we do. But we have seen founders who have running businesses profitably, and now they want to jump into the startup game because this area is very glorified. So startups got attention in last 10 years, and it has become funding or you are a failure. You should not look into that spectrum. You should have your analysis done. कि अगर आपका business चल रहा है without the funding, you should continue doing that and find out ways like debt is a good instrument. Don't liquidate if you don't want to. Then you can have banks coming across 3 years later. They will definitely give you funding for your growth stage also. We have seen companies just making companies just to get the funding because their peers have raised funds, and all that has added up to a chaos where everyone is rushing for the funding, not for the customers they want to sell the product to, right? So it is very, what do you say? You have to give it a thought. We have turned down proposals where we would have minted money for our LPs just because we knew that this founder is selling the equity so cheap right now because he want that equity capital. But for the betterment of the founder and the company, we always guided them that you should go long, you should get some debt from the market, you should scale this up, and then the valuation will be right, then you can raise the fund if you wish to at all, right? So raising funds, when to, why to, all that we have discussed, but I guess you should always evaluate, you should raise it or not.
Solid. I think, last but not the least, it's going to be under 10 seconds for each one of you. If you could actually share. Okay. Oh, okay. All right. No problem. All right. Thank you. Thank you very much. I think that probably we can connect off stage and continue this discussion or any of the questions that you might have. Thank you so much.